We all love a good deal, right? We've always looked for the cheaper gas station, even if it was only by a penny or two. And this is the same concept for investors that hunt down so-called value stocks. They're simply buying companies that others won't because other investors are too busy overlooking the business's full potential. And when that potential is eventually realized and the stock price rises, those said value investors cash out. As Warren Buffett put it, if I can buy a dollar for 90 cents, I'll do it. Now, don't get me wrong, Buffett's strategy seems easy when you look at it on the surface, but unfortunately, it's a little bit more complex than that. Because see, the key to value investing is being able to sift through the chatter, financial news, and being able to find the company's true intrinsic value. Intrinsic value is basically the value that the stock would have if everybody was on the same page about the stock. So once you find the intrinsic value, the next part is easy. You buy companies that have intrinsic value that is higher than the stock price. If all of that was confusing, don't worry, I'm going to be talking about everything that you need to know about the 3 companies that I'm going to go over right now at the end of the video. So without further ado, let's talk about company number 1, and that would be Verizon. You know Verizon. Odds are your cell phone plan is probably through Verizon. They're a pretty big company. However, what you might not know is that Verizon is one of the biggest value stocks in the S&P 500. Verizon's shares have only risen 6% in the past 3 years, and if you compare that to the S&P 500, which has risen 56%, got a long way to go to catch up with the broader market. So value investors look for stocks that are essentially unloved by the rest of the market. And the more we look at Verizon, the more we see that Verizon essentially fits the bill of being unloved. I think the vast majority of investors are pretty hesitant on Verizon right now, strictly because their main business is in the wireless business. The company is still very much a market leader, but growth in the sector is slowing a little bit. And thanks to T-Mobile, their market share is not as big as it once was. Verizon also has a lot at stake in the subscription television business. Not only is this an industry where customers are continuously cutting the cord, but it also requires a ton of spending on maintenance. So because of Verizon's wireless and TV business units, it's been struggling to increase sales over the past few years, understandably so. In fact, full year revenue was $128.3 billion in 2020, and that was lower than each of the previous 2 years. So after everything that I've just said, which seems not too great about the stock, it seems understandable that the price is trading where it's currently at. However, value investors might think that the price is a little bit too low. The big selling point is the fact that they are pointing to the whole 5G and the Internet of Things will hopefully profit Verizon into the future. So as long as Verizon is able to make money from emerging technology today, the stock could truly be considered a bargain. How much of a deal is it? Well, I'm going to get to that at the end after I continue going over the next 2 stocks. That way we just do it all together. It's easier. Speaking of the next stock, we have Berkshire Hathaway, ticker symbol BRK.B, if my memory serves me correct, and that is essentially Warren Buffett. And long story short, their whole philosophy over there at Berkshire is that they invest in companies that they think are undervalued. Berkshire is heavily invested in finance, energy, and transportation. Buffett recently said that most of the company's value comes from its insurance businesses, including Geico, the railroad, Burlington Northern Santa Fe, Berkshire Hathaway Energy, and its 5% interest in Apple. However, Berkshire's value is found in more than just its biggest holdings. At the end of 2020, Berkshire owned 5% in more than 3 major banks, including Bank of America, Bank of New York Mellon, and US Bancorp. As for why I think Berkshire is a deal today, well, think of it as a collection of companies that were deals when Buffett bought them. And again, I'm going to get to those numbers really soon, right after I talk about our third stock, which is, drumroll please, Home Depot. For those of you unaware, retail is an extremely tricky sector to essentially make money in. Constant threats from employees, customers, suppliers, and not to mention the disruption of e-commerce. So with all that in mind, many investors try to avoid this section like the plague. However, the company's focus on home improvement with hard-to-ship materials has prevented from Amazon essentially coming in and destroying them. Home Depot is also competitive at the store level by hosting workshops aimed at do-it-yourselfers, but I think most would say that the most exciting thing that Home Depot is doing nowadays is buying back its shares. Stock buybacks are essentially one of the ways that companies can reward their shareholders for owning the stock. And Home Depot has done this aggressively, to say the least. In the past 5 years, the company has lowered its share count by 14%. Lower share count essentially means that the current shareholders own more of the company. More bang for your buck. To go even further, if you had bought Home Depot 5 years ago, however many shares you owned, nowadays, if you're still holding it, you essentially own 14% more because of the buybacks. And just recently, Home Depot approved a $20 billion share buyback, a figure currently equal to 5% of the company's market capitalization. So as I mentioned earlier in the video, there are a lot of ways to essentially determine the stock's value, if it's priced right, equal, or underweight, blah, blah, blah. You know all those fun terms. So I'm going to essentially go over a few of them, and then I'm going to break down what each stock is in reference, if that makes sense. So to start out, we're going to be talking about earnings-based valuation. So one of the easiest valuation methods is its price-to-earnings ratio, or PE ratio. For those of you that are unaware, it's a simple calculation that divides the current stock price by its per-share earnings over the last 12 months, sometimes called trailing 12 months. Verizon is currently trading at about 11.5 times trailing earnings, compared with 34.5 times for the S&P 500. Essentially, what that means is that Verizon is vastly undervalued compared to the broader market. If the S&P 500 is the broader market, and that has a 34.5 PE ratio, and then Verizon has 11.5 PE ratio, undervalued. And if you thought Verizon's PE ratio was low, just wait until Berkshire's. You don't have to wait anymore. It's 6 times earnings. So again, S&P is 34.5, Berkshire is 6. Word to the wise, essentially, if you're looking at PE ratios, the lower, the better. Just don't go look at Tesla's and you'll be fine. And last but not least, Home Depot is the highest of the three, but it has trading at a 24 times PE ratio. So definitely higher than Verizon and Berkshire, but it's definitely still a lot lower than the 34.5 for the S&P 500. Now, using PE ratios is a fairly quick and simple and easy way of looking at it, but it's not always totally accurate. Because for starters, earnings can be calculated on past results and can often be influenced by one-time gain or losses. Other earnings-based metrics include forward price-to-earnings ratio, but these depend on analyst estimates that might not be realized if the economy changes, or if the company loses market share to competitors. Another way of trying to value a company is called asset-based valuation. Other value investors prefer to look at asset-based valuations like price to book, which divides the market cap by the book value, or the company's value reported on financial statements. The whole rationale is that the less you pay for net assets, the better of a deal you're getting. And there are flaws to this valuation as well, particularly if those assets don't generate earnings. As for our companies that we're talking about, Verizon is truly an asset-based value investor's dream. Thanks to its significant wireless and cable TV assets, the company has a price-to-book value of 3. Compared with the S&P 500, which now trades at an astronomical 900. Yeah, you heard me right. Verizon's asset-based value is 3. The S&P 500 is 900. Because of his focus on financials, Buffett likes to talk about Berkshire Hathaway's book value. Currently, Berkshire's price to tangible book value is 1.4. which is slightly elevated from its 10-year historical average, but significantly lower than the S&P 500 900. And the last way that we're going to look at these companies is by cash flow and hybrid valuation. So another type of value investor focuses on cash flow. And this makes sense because investors are looking to get paid in cash instead of accounting earnings or physical assets. Cash flow investors often focus on distributed cash or dividend yield as their preliminary metric. For me, I'll just say that Verizon sort of hit the value investing trifecta by paying a dividend yield of 2%. Unfortunately, Berkshire doesn't pay dividends, but most investors often are able to look past that, considering Buffett is one of the most, greatest investors of all time. So they just kind of let that one slide. And last but not least, we have Home Depot coming in with a dividend yield of around 2% as well. So all in all, those are my 3 value stocks that, according to the numbers, according to many other value investors, are currently undervalued. They are, I don't want to say due for a breakout. Like, no stock owes you anything. No stock is guaranteed to go up just because it hasn't been performing with the market. But let's just say that there is room to catch up should the stocks decide that they want to play the game of, going up like every other stock. That's it for this video. If you enjoyed it, let me know. Give me a thumbs up, subscribe, and as always, I will see you guys next video.